Assalamualaikum and hello everyone. My name is Muhammad Shahrul Nizam bin Kamaruddin. My matrix number is 07D81 at F2028. Okay guys, today I would like to explain about powers and duties of an auditor. Okay guys, the first one is duty to members. According to section 266 of the Companies Act 2016, auditors are required to attend the annual general meeting in which the financial statements are laid down before the meetings. Next, as we know, before the year ended, the accountant of the company should be provide the financial statement for the year ended before the annual general meeting. So, the second duties of auditor to the members is to obtain the reasonable assurance that the financial statement from accountant is free from the material misstatement.
Assalamualaikum and hi, my name is Siti Rafia binti Rano and my matrix number is 07D8018F2001 and I am from the 84B. I would like to continue my friends Nizam and Shafika's presentation. I will present about question 2, auditor's power and duties under the common law. There are 5 powers and duties of auditor under the common law. It is the duty to shareholders, duty to the companies, duty of care and skills, duty to third parties, and the last one is duty of confidentiality. Let me explain about the duty shareholder first. In duty shareholders, auditors are against of shareholders. Auditors are to be appointed by shareholders and not to report to them directly and not through at the directors. This is to ensure that the shareholders receive independent and reliable information respecting the true financial position of the company at the time the audit was calculated, as case Theo Peng Per vs. One & Co. in 2001. My friend Shafika will tell you about this case for more details. Hi, it's me again. I will continue for the second duties. It is duty to the company. It is fiduciary duty of an auditor to treat company's information and trade secret acquired in the course of his or her professional work as confidential. Further, duties of an auditor are duty of care to the company, duty to audit company's financial affairs and form an opinion required, duty to audit company's financial record generally, duty to report to members of the company account in the annual general meeting, and lastly, duty to use reasonable care and skill while conducting audit and making the report. The third of power and duties auditors is duty to care and skills. It is a duty of an auditor not to use company's information to gain advantages or benefits for himself or herself. It is important for him or her not to conflict his interests with the company's interests. For example, to make profit secretly or acquire interests using company's confidential information, like the case Patrick Tay versus Public Accountant Board in 2002. Like before, my friend Shafika will explain about this case. Let's continue to other duty. It is duty to third parties. Under the common law also, an auditor may owe duty of care and skills to persons other than the company itself. Even though there is the not contract between them, such as the investor and clients, the auditor may be liable to third parties for their losses as a result of negligent audit done by the auditor. Let's hear the explanation from Shafika about case for this duty, Caparo Industry Page versus Dickman in 1990. For the last power and duties auditors under the common law, it is duty of confidentiality. As for the confidentiality, an auditor may disclose confidential information without the company's consent only in the following situation. It is for the purpose of discharging duties to the company. Next, in accordance with provision of return if disclosure is compelled by the process of law or by competent authority, and if disclosure is necessary to protect auditors' interests. It is important to highlight that under the Companies Act 2016, there is no such duty because the duties of an auditor are normally contractual in nature.
For question 1, the case is case Percival versus Whitewright. Is a UK company law case concerning directors' duties, holding that directors only owe duties of loyalty to the company and not the individual shareholders. Excuse me. This is now codified in the United Kingdom's Company Act 2006, Section 170. Facts: shareholders in Nixon Navigation Company wanted to sell their shares and requested that the company's secretary find the best purchasers. Some directors of the company purchased the shares at $12.10 per share, which price was based upon independent valuation. After the sales, the shareholders discovered that before and during the negotiation for the sale, the board of directors had been involved in other negotiation to sell the entire company, which would have made those shares substantially more valuable had they come to fruition. The plaintiff made those shares substantially more valuable had they come to fruition. The plaintiff sued, claiming breach of fiduciary duty that the shareholders should have been told of this negotiation. Excuse me. The decision is, it was strenuously urged that throughout incorporation affected that the relation of the shareholders to the external world, the company therefore becoming a distinct entity. The position of the shareholders intersect was not affected and was the same as of partners or shareholders in an incorporation of the company. I was unable to adopt that view. There is no question of unfair dealing in the case. The director did not approach the shareholders with the view of obtaining their shares. The shareholders approached the directors and named the price at which they were desirous of selling. The plaintiff's case would fail and must be dismissed with cause. For question 2 that I'm going to explain, there are 2 cases. The first case is Theo Peng Fee vs. One and Co. 2001. The court held that the auditor had failed to disclose the irregularities in the accounts to the company. Furthermore, the auditors owed a moral duty to disclose the identity of the wrongdoer, the director, to the minority shareholders. This is because of the debtor of the company were this director. This was not disclosed to the shareholders. And then the second case is Capero Industry PLC vs. Dickman, 1960. Facts: Capero, a small investor, purchased shares in a company relying on the accounts prepared by Dickman. Capero lost money due to the accounts being negligently prepared. So the issue is, could Dickman be liable to Capero for not negligent preparation of the rely upon company's accounts? Capero for not negligent preparation of the rely upon company's accounts, given there was no contractual relationship between the two parties. So the decision is, it was decided that there was a proximity between the parties, that there was foreseeability of the loss and damage. The Capero test foreseeability, proximity, and fair, just, and reasonably was felt due to lack of proximity, allowing claim with liability in an indeterminate amount for an indeterminate class. In claims for economic loss, there must be a common purpose, approximate relationship, known communication with expected reliance, and actual reliance. There was no proximity, as the defendant knew nothing about Capero. Thank you.
You and me, you and me,